Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color podcast. This is a weekly podcast that is dedicated to providing our listeners with an up-to-date overview of the Kenyan financial markets. However, due to the interconnected nature of the global economy, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the local markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. This podcast is targeted at the individual with an interest in the financial market, but who probably doesn't have the time for research and analysis. That's why I created the Market Color podcast to call it and analyze the data on your behalf and to present it in a brief and concise manner that is easy for you to consume. This podcast may also be useful to fund managers and investors, professionals in the financial services sector, business owners and leaders, as well as Kenyans in the diaspora who are looking for investment opportunities back at home. This week, we are reviewing the performance of the Kenyan markets during the 45th week of 2022, that is from Monday the 7th to Friday the 11th of November. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United Kingdom, where the economy contracted by 0.2% in the third quarter of 2022, signaling what could be the start of a long recession. However, this contraction does not represent a recession, which is characterized by 2 consecutive quarters of negative growth, and that is because the second quarter's contraction of 0.1% was revised to a growth of 0.2%. The Bank of England just last week forecast that the United Kingdom was entering what could be the country's longest recession, which is expected to last until 2024. Meanwhile, China's state media announced on Friday that the quarantine period for international travelers has now been reduced from 7 days to 5 days. The easing of restrictions is expected to be positive for the Chinese economy as economic activity begins to pick up. In the United States, the consumer price index rose less than expected in the month of October, which was an indication that inflation is beginning to cool off. According to the Bureau of Labor Statistics, the Consumer Price Index, which is a broad-based measure of the cost of goods and services, increased by 0.4% for the month and 7.7% from a year ago. While the Core Consumer Price Index, which excludes food and energy prices, increased by 0.3% for the month and 6.3% on an annual basis. However, despite the slowdown in inflation, the rate still remains well above the Fed's target level of 2%, plus the fact that 1 month's data does not constitute a change in the overall trend. Moving over to the US stock market, the S&P 500 closed out its best week since June on the back of the inflation report, which raised hopes that the Federal Reserve would soon slow down its aggressive tightening campaign. The Dow Jones Industrial Average gained 0.1% to close the week at 33,747. While the broader market index, that is S&P 500, added 0.9% to close at 3,992, bringing its weekly gain to 5.9%. And the Nasdaq Composite added 1.9% to close the session at 11,323. In the U.S. bond market, U.S. Treasury yields tumbled across the board after the Consumer Price Index for October came in weaker than expected, signaling that inflation may now be past its peak, and therefore the Federal Reserve could now pivot and begin to slow down on its aggressive rate hikes. The benchmark 10-year Treasury yield plunged more than 32 basis points and fell below the psychological 4% level to close the week at 3.816%. While the yield on the policy-sensitive 2-year Treasury note fell 30 basis points to 4.328%. Markets are now pricing a 71% chance for a 50 basis point rate hike at the Fed's next policy meeting in December. In the commodity markets, the price of crude oil jumped more than 3% on Friday after Chinese authorities eased some of the country's COVID restrictions, raising hopes for improved demand from the country's largest importer of crude oil. Brent crude rose 2.4% to $95.95 a barrel, whilst the U.S. benchmark West Texas Intermediate gained 2.9% to $88.94 a barrel. The price of Marbon oil, which Kenya imports, fell to $91 per barrel from $93.26 the previous week. In the gold market, the price of gold was up about 5% for the week and was trading near a 3-month high as signs of cooling inflation in the US bolstered the view that the Fed Reserve would be less hawkish on rate hikes going forward. The inflation data triggered a sharp fall in the US dollar, making gold more appealing for other currency holders. And as a result, spot gold gained 0.6% on Friday to close the week at $1,765 per ounce. In the currency market, investors fled from the dollar as the currency plunged after the softer than expected US inflation data indicated that the Fed Reserve may begin to slow down on its monetary tightening policy. The US currency was down about 3% against the Japanese yen and was off about 1.7% versus the euro. Meanwhile, the dollar index, which is a measure of the greenback against a basket of currencies, that was off about 2% at 106.42. In the crypto world, devastating news for crypto investors and traders as FTX, which is the second largest cryptocurrency exchange, filed for Chapter 11 bankruptcy protection in the US, and its founder and CEO stepped down to facilitate the winding up of the firm. In the space of a few days, FTX went from a valuation of $32 billion to bankruptcy as liquidity dried up and customers started withdrawing their digital coins and tokens. To add insult to injury, the company is suspected to have been hacked and lost about $600 million in various tokens that were drained from clients' crypto wallets. The collapse of FTX has seriously damaged the prospect for cryptocurrencies becoming a mainstream investment asset. We now change scene to the Kenyan financial market, and as is the norm, we start off by looking at exchange rates. During the week, the Kenya shilling remained stable against major international and regional currencies. Against the major currencies, the Kenyan shilling was trading at 121.74 versus the US dollar and 139.69 against the sterling pound and 122.34 versus the euro. On the regional front, one Kenyan shilling was changing hands for 31.01 Ugandan shillings, 19.16 Tanzanian shillings, and 8.78 Rwandese francs. Please note that while the official exchange rate for the dollar shilling, as published by the Central Bank of Kenya, stands at 121.74, the effective exchange rate which commercial banks are offering their clients is now above 130 shillings per dollar. On foreign exchange reserves, Kenya's usable foreign exchange reserves remained adequate at $7.235 billion. That is equivalent to 4.05 months of import cover and meets the central bank's statutory requirement to maintain at least 4 months of import cover. However, Kenya's foreign exchange reserves have now dropped to the lowest level in 7 years, which is a clear indication of increased payments to service our foreign external debts. Our foreign reserves have now declined from a peak of $8.81 billion recorded at the beginning of this year to the current levels of $7.23 billion, which is a decline of $1.58 billion in a period of just 10 months. In the money markets, the liquidity situation in the interbank market improved slightly on the back of government payments that exceeded and more than offset tax remittances. Commercial banks' excess reserves in relation to the 4.25% cash reserve requirement stood at 28.8 billion shillings. Meanwhile, market operations remained active with the average interbank rate at 4.36% compared to 4.75% the previous week. During the week, the average value traded decreased to 13.1 billion shillings from 20.4 billion shillings the previous week. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 10th of November, with the central bank receiving bids totaling 49 billion shillings against an advertised amount of 24 billion shillings, representing a performance of 204%. However, of the 49 billion shillings received, the central bank only accepted 38.3 billion shillings. Interest rates on all the three tenors increased marginally but remained stable, with the 91-day rate rising 3.4 basis points to 9.17%, while the 182-day rate ticked up by 1.5 basis points to 9.7%, and the 364-day rate increased by 7.7 basis points to 10.18%. In the primary bond market, the Treasury bill auction for the 14-year fixed-rate infrastructure bond was held on Wednesday, the 9th of November, and the central bank received bids totaling 91.8 billion shillings against an advertised amount of 60 billion shillings, representing a performance of 153%. However, of the 91.8 billion shillings received, the central bank only accepted 75.5 billion shillings at a weighted average rate of 13.938%. Infrastructure bonds remain popular with the investors because the interest earned is exempt from withholding taxes. In the secondary bond market, the turnover in the domestic bond market increased by 44%. Meanwhile, the yields on Kenya's Eurobonds continued to decline, which is an indication of improved risk sentiment about the Kenyan economy. The yield on the 7-year Eurobond issued in 2019 declined the most by 310 basis points to 11.3%. whilst the 2024 maturity declined by 287 basis points to 12.8%. In the equity market, during the week under review, the market recorded a mixed performance with the NASI gaining by 0.4%, while the NSE 20 and the NSE 25 declined by 0.5% and 0.2% respectively. This takes the year-to-date performance to losses of 23% for the NASI, 13% for the NSE 20, and 18% for the NSE 25. The market's performance was mainly driven by gains recorded by banking stocks such as Absa Bank and NCBA Group, which rose by 2.6% and 1.9% respectively, while Safaricom inched up by just 1.8%. These gains were, however, weighed down by losses recorded by large cap stocks such as East African Breweries, which declined by 4.3%, whilst Equity Group, Bamburi, and Kenya Commercial Bank Group were down marginally by 1.3%, 1.2%, and 1.1% respectively. Meanwhile, market capitalization increased by 0.7%, whilst equity turnover declined by 8%. In related news, Safaricom released its financial results, which showed that net profit for the half year ended September fell by 10% to 33.5 billion shillings. This dip in net profits was attributed to a significant reduction in the mobile termination rate, as well as increased costs associated with the entry into the Ethiopian market. Total revenue rose by 4.6% to 153.4 billion shillings, boosted by an 8.7% increase in M-Pesa revenue to 56.9 billion shillings and an 11.3% jump in data earnings to 26.3 billion shillings. Meanwhile, voice revenue fell by 3.8% to 39.9 billion shillings, whilst total cost rose by 30% to 31 billion shillings, mainly driven up by investments in its new Ethiopian subsidiary. For your information, the Capital Markets Authority, in its Market Soundness Report for the third quarter of 2022, showed that foreign investors at the Nairobi Securities Exchange reduced their shareholding by 360 million shares, which resulted in a net outflow of 19.5 billion shillings in the 9 months to September, reflecting the sustained capital flight from emerging markets to the West. And now an update on Kenya's national debt. According to the Central Bank of Kenya, total government debt as of September 2022 stood at 8.7 trillion shillings. This was equally divided between domestic debt at 4.37 trillion shillings and foreign external debt at $39.36 billion, which is equivalent to 4.33 trillion shillings. And now a look at the economic calendar for this week. On Monday, the 14th of November, Japan releases its gross domestic product for quarter 3 2022. This is a measure of all the goods and services produced in Japan and indicates the pace of growth or contraction of the Japanese economy. On Tuesday, the 15th of November, the United Kingdom releases its unemployment rate for the 3 months to September 2022. The unemployment rate is a measure of unemployed workers and is a broad indicator of Britain's labour market and the economy in general. On Tuesday, the 15th of November, the European Union releases its gross domestic product for quarter 3 2022. This is a measure of the total value of goods and services produced in the Eurozone and is a broad measure of economic activity in the region. On Wednesday, the 16th of November, the UK releases its Consumer Price Index for the month of October 2022. The Consumer Price Index is a measure of inflation and compares retail price changes for a representative basket of goods and services. On Wednesday, the 16th of November, the US releases data on US retail sales for the month of October 2022. The retail sales data is a leading indicator of consumer spending, which contributes about 65% of the gross domestic product in the United States and therefore points to the health of the US economy. We now look at the topical issue for this week. This week, the topical issue is on the presidential directive to keep borrowing costs below 10%. An interesting episode happened this past week when the president issued a directive to the Treasury instructing them not to accept any borrowing above the rate of 10%. The president indicated that borrowing above 10% was not sustainable for the country. This directive from the president is commendable and understandable. However, in my view, it is not practical. And the reason it is not practical is because money has a cost, and the cost of money is determined by market forces of demand and supply, as well as the rate of inflation. We start off by looking at demand and supply. Based on the budget estimates for the fiscal year 2022-2023, the government had projected to incur a deficit of 862 billion shillings, out of which 582 billion shillings was to be funded from the domestic market. Given that scenario, the market is well aware that the government is in dire need of funding, and based on that demand, the market will price the cost of money accordingly. The second factor to consider is inflation. The latest inflation data shows that inflation in Kenya is running at a rate of 9.6% and is expected to continue rising, driven up by higher food and fuel prices. What that means is that any investment generating a return below 10% is actually losing value over the long term. Therefore, investors who are looking for a real rate of return will only invest their funds if they can obtain a rate which is above the current rate of inflation. The president also mentioned that if the Treasury is unable to obtain funding below 10%, then the government will opt for other sources of finance. The question is, what other options does the government have? To my knowledge, the government has only 4 other options to finance its budget, and these are: number 1, commercial loans; number 2, Eurobonds; number 3, bilateral borrowing from other countries like China; and number 4, concessional loans from the World Bank and the IMF. However, in my view, these options are not viable for the following reasons. Number 1, our debt to GDP ratio currently stands at 70%, and this is way above the IMF threshold of 50% for developing countries like Kenya. Number 2, our debt service to revenue ratio now stands at 50%, meaning that for every 1 shilling that Kenya Revenue Authority collects, 50 cents goes towards repayment of our national debt. Number 3, the cost of issuing a Eurobond has risen as high as 22%, but that is now down to about 13%, which is still above the government's target rate of 10%. Number 4, in May 2022, the International Monetary Fund downgraded Kenya's risk of debt distress to high, meaning that the country is now viewed as being at a high risk of defaulting on its external debts, and therefore further borrowing is highly unlikely to be approved. The only relief for government will come at the short end of the yield curve, where the government is borrowing funds using treasury bills whose rates are now currently hovering around the 10% level. However, the real challenge will come at the further end of the yield curve, where the government is issuing a longer dated treasury bonds, where rates have recently peaked at about 14%. All we can do now is wait and see what happens at the next bond auction. In the meantime, all I have to say is this: Mr. President, welcome to the market. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast. We hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. We really do appreciate your assistance in this effort. For your information, in addition to our usual audio directories, that is Apple Podcasts, Spotify, and Amazon Music, the Market Color podcast is now available on YouTube. Please subscribe and remember to turn on alerts to be notified of new episodes. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support. I look forward to interacting with you again next week. But before I sign off, please allow me to share with you this quote from the poem The Invitation by Oriah Mountain Dreamer. And it goes like this: It doesn't interest me what you do for a living. I want to know what you ache for, and if you dare to dream of meeting your heart's longing. I wish you a great week ahead. Thank you, and God bless.